elevation. We hunt and we hungry, we celebrating, turning nothing to something and celebrating. Markets changing, recalibrating. The first to get acclimated is the first to stack the payments, but you need to act with patience, but be careful waiting, cause this opportunity won't last forever before it is evaporated. So if you wanna flip some houses, hit me up to make a plan.
Hey everybody, welcome back to another episode of Raising the Flipping Bar. I'm your host, Eric Marlin, and today we're going to talk about something very timely. If you've been following the news and the headlines, President Trump is talking about banning institutions from buying more rental properties. So big tagline, big headline. We're going to dive right into today's episode because I think it's super important, not only because we have a ton of experience in this space. So again, I'm not really here to get political, but where I am here to get is factual. So let's jump into today's episode. So I've been reading a ton of headlines and obviously talking about this, institutional ban and people freaking out about institutions and hedge funds and private equity and all these people buying rental properties and that being the devil. It's kind of crazy. I have a lot of experience in this. And when I was preparing for today's episode, it made me think back to actually when I was really little. So I'm originally from New Jersey. My whole family on my dad's side worked in Wall Street. And so my father literally worked on Wall Street. He would commute into the city all the time. We lived about an hour and a half northeast in New Jersey with a lot of other trader families, and everybody commuted into the city every day. And so I'm one of four boys. And it's funny because probably growing up playing too much football and getting hit in the head, there's certain memories I don't remember a damn thing. But one that is crystal clear for me pretty early on was when I was in fourth grade. And I'm one of four boys. And my mom took us into, everybody back there calls it the city. And so we went into New York City. The funny thing is now I think today with my teenagers, like I can barely get them to get out of sweatpants half the time. Love you girls, but let's wear something other than sweatpants. But we used to have to wear a suit and tie and to go into New York City to visit my father. And so obviously times have changed, of course, a crazy amount. But I remember getting dressed up in a suit and tie, all of us having those ridiculous, 80s bowl cut, feathered haircuts and our little blue blazers. And my mom's taking us into, the skyscraper on Wall Street to visit my dad. And some, granted, this is probably not PC, but like some old white guy probably was 45. He's probably younger than I am right now. But he's turned to my mom and said, "Hey, do you want to see something that you'll probably never see again? I love you, Mom, but this is a little naive." She's like, "Sure, let's go, boys." And so we walk into a different building next to where we were going, where my dad worked. And I'm glad that we didn't get killed or mugged or whatever else. But the crazy thing is he led us onto the floor of the New York Stock Exchange. And I remember it like it was yesterday. It was so freaking loud. The doors literally kind of busted in, and he just let us stand there and kind of see what it was like on the stock exchange. So you hear people screaming. I don't know whether it was my dad that taught me first, but definitely these guys taught me some colorful language, being a fourth grader, dropping F-bombs every third letter. Or every third word that I should say, doing the hand signals. Like I felt like it was Trading Places. For those of you guys that aren't too terribly young, go watch Trading Places. But it was just like, as my wife Ann says, like buy, sell, buy, sell. Like it was just mayhem and it was out of control and it was super crazy. And so I remember that like it was yesterday. So I kind of have this literal and figurative, exposure to Wall Street. And so it really kind of makes me think back to fast forwarding to today. The crazy thing is when I worked in the family business, again, everybody was primarily bond traders. So not on the equity or on the stock side, it was more on the bond side, which is actually significantly larger. The debt side of, finance and Wall Street is significantly bigger than the equity side or the stock side. And so I ended up actually working in a boutique brokerage with my dad. 35 years later, we started a small bond trading company together, which was great experience. I got my Series 7 license. I got my Series 63 license. My dad had a ton of, principals licenses. He'd been a trader for 40 years. And I think that's one of the things that actually helped us work with hedge funds. And so to kind of set the stage for our experience, which again, we're talking about Trump headlines versus what is actually happening today and what we see at Elevation. We've now been in this institutional and hedge fund side of the rental business for actually almost 5 years now. So the crazy thing is I was looking back at my notes and we started working with hedge funds, I think a lot in part because of my background blending finance with real estate investing. And we did just over 300 transactions where we were primarily on the buy side working with institutions. And so they were buying single family rentals. They were buying them to do kind of a rental quality fix up. put a renter in there, and then add it to their portfolio. So just in Denver, we did just over 300 transactions, and that was in about an 18-month time frame, done from 2021 to 2022. So wanted to give a shout out to one of our agents, Jonathan McAlandre. He's since moved out of state, but he crushed it. I mean, the dude was writing like 30 offers a day. So for those of you that are like, oh, I'm working hard, I'm writing 2 offers a day, Jonathan cranked out 30 offers a day. And we had our best month where we did 53 transactions in 1 month. So again, I'm not saying this to brag. I'm saying this to just demonstrate that we've got experience in this space. And so then the middle of 2022, it just completely shut off on the buying side. And that was primarily because interest rates, if you remember, were like hockey stick up and to the right. Obviously, we went, post-COVID, coming out of that, they're trying to get inflation under control. The Fed just jacked rates up. The 10-year treasury, which is actually what your 30-year mortgage rate is primarily tied to, that went through the roof. And then there was an extra spread that they needed for the risk reward factor of buying those mortgage-backed securities. And so there was kind of another 18-month pause where things went totally silent from second half of 2022 and really all the way through 2023. And then things started picking up more on the disposition side or the sales side for us. And so from 2024 and all of 25, and now we're starting to do it a little bit in 2026, is we would work with different institutions. It was kind of good. I probably would have felt bad if all the inventory that we acquired for our number one fund in Denver, they're like, this stuff sucks, let's sell it. Good for them, bad for us. They haven't wanted to sell anything. So it's been 2 new funds that we've worked with in the past 2 years where they either buy a housing inventory nationwide from another fund. Maybe a fund goes under, maybe they just need to liquidate and need cash on hand to get into different business ventures. But what would happen is the second fund or the buying fund would end up looking at their inventory and say, you know what, these things don't fit our buy box, or these things don't fit our long-term hold strategy. And so we're selling those off for clients. And so we've done about 100 transactions in the last 2 years with our team. Because again, we have a whole division now dedicated to this style of business. I really enjoy it and we're good at it. So again, we've seen buy side, we've seen sell side. I, kind of seen behind the curtains from my family. And so I wanted to kind of give you guys that frame of reference because again, everybody throws out headlines, but what's actually going on? So that's exactly what's been going on for us in the last 5 years in Metro Denver. So again, we don't want to celebrate panic. We don't want to have people freak out, but we just need to look at, I think importantly now coming up is, okay, what's the overall history of Wall Street owning rental properties and creating this new asset class? So historically, where this really came from is the great financial crisis or overall the housing market crash of 2008 and kind of that ripple effect for honestly, at least the next 2 years where things were really, really rough, essentially nationwide, starting in 2008 when Bear Stearns and Lehman Brothers went out of business. There was Wall Street capital where people had invested with different large institutions and they saw the price of houses just rapidly plummet. I mean, I'm talking in Denver, it was between a 30 and 40% drop. There were markets like Vegas, Phoenix, parts of Southern California, where it was a 50 to 60% drop in the value of a home, which to me, that's obviously like a legit major crash. So what they would do is essentially Wall Street started buying up single family properties and created a whole new asset class that really didn't exist before. So from 2008, this really started to ramp up and get really, really busy leading up until when the frenzy kind of happened, which was 2018, 19, and really 2020, things got kind of put on rocket fuel. And that's because interest rates went super, super low. And so what happened at that point was these institutions would come in, they had all this money that they had raised, they would be a cash buyer. So what they would do is buy the property, fix it up, turn it into a rental grade, and then put it in their own portfolio. Again, I don't know for sure on the back end, but to me, these are smart Wall Street traders. If they're borrowing at 2 or 3%, they're going to buy it in cash, they're going to fix it up and then reposition it. With inflation, that's free money. And so people were buying, a significant number of homes across the country, or at least what felt like a significant number of homes. And then again, we kind of said it, the brakes freaking hit hard in the middle of 2022. And I think the tough thing for us is I remember this very vividly. It was June 17th, 2022 at Elevation. We call that Black Friday because we had a handful of deals that were getting extended and we knew something was going on. Again, these 2 institutional clients that we had, they knew something that we didn't. And it was that interest rates were going to get jacked up really, really quickly. And so they actually terminated just in Denver on 17 properties that we had under contract. And they didn't even, really have a budge or give a care about giving the sellers their earnest money. It was like, hey, we knew that we thought we wanted to buy these, something major changed, keep all this money. So just in our market, they probably walked away from between 75 and 80 grand of earnest money. From an elevation perspective, the crappy thing is we lost out on the opportunity to make a nice 6-figure revenue month in the month of June 2022. So it was, not a great situation, and obviously crappy for the homeowners where they thought they had a sale and these folks just bailed. Kind of again, fast forward to where we're at today. In 2024 and 2025, people are doing what we're calling strategic disposition. And again, this is Metro Denver. There are other markets that we'll talk about here in a second. They've still been buying, and they have been buying throughout the Midwest and parts of the Southeast. But that's kind of where we're at for Denver. I was looking back at some of our data, and the tough thing is on these properties that we're now selling, we had a handful of clients that bought in the middle of 2022. So the absolute peak, we are now giving them their valuations and they're selling at a loss. The good news is for these clients, typically they're thinking in two different thought patterns. One is they've collected rental revenue for 3 years. So that's obviously a positive. As long as the house didn't get trashed, they've, had some tax benefits from a depreciation standpoint. So net, they're probably not losing money, but more importantly, it's like they don't want to own certain things that are outside of their major wheelhouse. So interesting example is we just listed a property last week in Manitou Springs. Again, I hate to beat somebody up, but like what brainchild looked at a spreadsheet, in 2021, 2022 and was like, oh yeah, we're going to get this great deal in Manitou Springs, which for those of you guys, that know Colorado, it's a small, I don't even want to say resort town. But I don't know why a hedge fund would freaking own a rental property in Manitou Springs. So it makes perfect sense to actually sell that thing off. So again, these people are just recalibrating things. And really what I want to get at now is who really owns these rentals? So we've kind of framed this thing out talking about how our experience has shaped today's episode, where the history comes from. Now I want to get to the numbers. And again, I'm not here to get political, but shocker, President Trump has thrown out a big headline statement, but there's not facts to back it up, in my humble opinion. So if we think about the headlines, it's like hedge funds own everything and institutions own every property, across the United States. I pulled a ton of data. And so I would really, really encourage you guys to look at the show notes. We've got about 10 different data sources, data points, articles, government statistics. So this is all factually based. I'm sure there can be a little bit of nuance of pulling one set of data versus the other, but in general, this is based on facts. And so from the Governmental Accountability Office, or the GAO, here's the big thing is they define kind of two terms that I found. One is either a mega investor, or another is they call them just a large institutional investor. And these are people, or companies, I should say, that own at least 1,000 or more single family properties. And again, they are detached homes. They're not condos. They're not townhomes. Good for them now, because that would be a bloodbath. But again, the big boys and big girls of Wall Street that own 1,000 or more homes only make up 1 to 2%. So again, just let that sit in. When everybody's freaking out, Wall Street owns everything. This is nationwide. They own 1 to 2% of the housing stock. So that kind of throws, the headline myth just completely out the window. If we go down and talk about other professional investors, or sometimes also known as institutional investors, and this is people that own between 100 999 houses. So definitely the major high net worth individual, a private equity fund, these are people that own a lot. Again, maybe not as much as BlackRock. They only own nationwide between 3 and 4% of these single family rental properties. So obviously, simple math, we're talking 5 to 6% owned by quote unquote the big boys and the big girls of Wall Street. I don't know. Sorry, I get kind of fired up and pissed off. Like, it dispels the myth. Like, do your research and get your facts right. Where the interesting thing is the next tier of rental investors are kind of bucketed between what people call mom and pop investors, meaning people like you and me that own, a handful of rental properties, typically 10 or less. Technically, the definition would be 99 or less, but for the most part, it's people that own a handful of properties. Nationwide, about 20% of our housing inventory is owned by, let's call it, individual investors. So yes, when you smash all three buckets together, we're leaning towards a quarter of the housing population that is a rental property owned. But really, it's Main Street of America owns these rental properties. So if you think about it, like if you bought your first house, you bought it at a good time, you've got a good interest rate, your family grows, you need a bigger house, and you hold on to the first one, that's a great way to create wealth. You are the problem. Sorry, I'm giving you a hard time. But like on paper, technically we are the problem, but we're also the solution. And we'll talk about that here in a minute when it comes to affordability. So I just wanted to kind of create those three buckets of actual information, dispel the myth that the big boys and big girls, the bad guys of Wall Street own every single house out there. They own freaking 1% to 2% of the housing stock in America. And so what I want to talk about now is kind of like, okay, how does that affect our 2026 strategy? And so if this quote unquote ban comes through, it's kind of thinking of like, well, who wins and who loses? I don't know if the actual winner, which is what the administration and policy wants to drive, is the affordability side of things. I think it's just small time investors, individual investors versus the, Wall Street. That's really a matter of who wins and who loses. I think the other thing is we got to think of it from an agent perspective. If it increases transactional volume, which we hope that it would, that would be a win for agents. But again, if there's this ban, people like us aren't going to be doing as much business in this division for elevation, or if people are working with other brokerage teams, their volume is going to be down. So that person, gets hurt. So there's always kind of like two sides of the coin. I definitely think it's all about where's the competition the highest. And so we're going to talk now about like, this is where I think it's a little bit more poignant. And that is the top 10 markets nationwide that actually have a larger amount of institutional investors that own these houses. So as we jump into, again, looking at this data, the two main resources that we're going to be pulling from is the Urban Land Institute and also CoreLogic. So again, two very large, reputable data sources and companies that are pulling this information. So I think that the areas where I probably would be a little bit more concerned, or maybe a little bit more riled up if you are a first-time home buyer trying to buy a property, are these markets. And I've known of this, but it's interesting to pull the most recent data. And I found up to, Atlanta, the metropolitan area of Atlanta, Georgia, 27% of the housing inventory are actually owned by large institutions and investors. And they've kept buying and they've never stopped buying. Again, I think that the two factors of that are obviously still reasonable interest rates and then just cheaper housing. Like you can literally buy 2 to 3 homes in Atlanta for what you get for one home in Metro Denver, for example. Number 2 on the list is Jacksonville, Florida. Just over 22% are institutionally owned. This one surprised me. Charlotte, North Carolina. My folks live in North Carolina and we fly in and out of Charlotte. Doesn't feel that way from a rental perspective, but they own almost 20%. It's 19.74%. Tampa, St. Pete, Florida, just over 16% are owned by institutions. This one didn't surprise me. Phoenix, the Phoenix, Mesa, Chandler, Arizona, kind of Phoenix MSA. It does drop down to 15.5%. And then you go Raleigh, Durham at 14%, Orlando at 14%, Indianapolis at 13%. This one surprised me. Birmingham, Alabama, 12.5% are owned by institutions. And then number 10 is Nashville at just over 12.4%. So pretty big drop off when you think about it, when you've got, 3 of the top markets right around 20% or more, and then you dip down to about 12%. But again, I want to kind of really frame this of, again, that's where institutions own more stuff. So I think that argument is maybe a little bit more valid there. And then it drops rapidly. And so let's bring it back home to our backyard in Metro Denver. The funny thing is I couldn't even find it that most lists, we didn't even show up on the top 100 of metro areas owned by institutional investors. The only data point that I could find is that we are overall, so we're less than ranking of number 100. This is, okay, let me make sure I get my facts straight. Yeah. So in Colorado, overall, only 3% of properties in our state are owned by rental property owners. And so again, that's everybody. That's the institutions, that's the large investors, that's the professional investors, that's the mom and pops, that's everybody. And so if we then segment that down to Metro Denver, what I looked at is how many single family homes are in our metro area. So again, not condos, not townhomes, but detached single family homes. And the data that I found is 840,000 properties are available in Metro Denver. And so again, if we look at that 3%, that means that only just over 25,000 homes in Metro Denver are rental properties. And again, I'm kind of, using nerd math here. If we go back to the start of the episode, which is that on average, institutions might own 2 to 3%, that means that there's less than 1,000 properties owned by institutions in Metro Denver. So we're not moving the needle. If we look at the exact number, again, if my kind of janky math is correct, 756 houses. That might be a little low. That means we crushed it. That means we sourced almost 300 of those for one of our major clients. So maybe that's a little bit low, but I don't know, like 1,000 homes are owned by the large institutions. And so that's not affecting affordability. I would actually say that it's helping affordability. We'll talk about that here in a second. But to kind of put a bow on the data of how it relates to Metro Denver, right now, as of December, and these are DMAR stats, there's just under 10,000. So there's 9,833 homes that are either available for sale or pending. So again, under 1,000 are owned by the big boys and girls by Wall Street, and we have 10,000 available homes for sale. So again, it's just like, it just doesn't add up. So I just think it's another thing that just gets thrown out. Conceptually, I'm here to obviously help with affordability, but that's not going to be the case of like cutting off Wall Street from buying single family homes. It's not going to move the needle. So I think as we get into like, again, what's the real impact? We're talking about national affordability. There's minimal impact. The main impact we're talking about is the shortage of overall housing. That's what we need to add to. If we think about it on a local basis, again, maybe it impacts those metropolitan areas in the top 10, but really not everybody else. And then here's the other thing is, how the hell would we really enforce that? It just seems to be such an impediment to commerce. And again, I'm not here to get political, but who's donating to those people's, campaign funds too? It's Wall Street. So I just don't see this coming down the pipeline and having a meaningful impact at all. What we need to think about is, how do we get mortgage rates a little more under control to make it more affordable? How do we get construction costs under control? How do we speed up approvals in the permitting and the zoning process? That is a huge, huge bottleneck. That's the kind of stuff that we need to focus on over the next 1 to 3 years. That's going to help affordability. I'll probably record an episode on it, but the 50-year mortgage, that's another interesting thing. If you think about when the 30-year mortgage was instituted, people freaked out. Back in the day, they used to buy mortgages, or buy properties on like a 5-year mortgage. And everybody freaked out. They instituted a 30-year mortgage coming out of the Great Depression. And shocker, affordability helped out a lot, and lots of people bought homes. It's going to be the same thing for a 50-year mortgage. So let's look at those 4 or 5 things, and let's not focus on trying to chase Wall Street out of buying something that honestly they're not buying anyways right now, because interest rates are so high and prices are still very, very healthy in the vast majority of metro areas. So I think that's something that, I don't know, it's just kind of funky when you look at it, and it's essentially, again, it's just about fact checking. And so something that I want to kind of wrap today's episode up with is twofold. One, I think there might be an unintended consequence. And here's what it is. If institutions get spooked, or they're tired of, the rhetoric in Wall Street, and they start selling off those houses, that will actually be, I think, another hindrance, because there's a lot of people that can't afford to buy homes right now, but they actually can afford to have a nice rental property. And a rental property owned by an institution is typically going to actually be better maintained, because they've got the scalability to maintain those properties, and you're paying low rent for a nice overall house. A lot of times as individual investors, if my cash flow is getting killed, I mean, obviously I want to replace the water heater, I want to fix whatever, but one major repair evaporates your entire net profit for an entire year. So again, there's pros and cons. That means that rents might get pushed up. So I just think people need to really think about what this really boils down to. So as we wrap up today's episode, I hope you found this, enlightening. I hope you've mostly just worried about fact checking and really looked at what's actually going on. And it's funny, I started the episode thinking about when I was little, to my first exposure on Wall Street and the New York Stock Exchange, kind of coming to a weird full circle moment. I was driving my son back to college. He goes to school at Western Washington in Bellingham, Washington. So we're on a 23-hour road trip, which is just something that I cherish. And I don't know, side note, drive your kids back and forth to school. It's just, you get to know each other so much better. And really have a great time and come up with, like unique talking points and conversations. So we had listened to a podcast that, as my girls say, is a little more businessy than, listen to Childish Gambino, on his playlist. But he kind of, is a 20-year-old kid. He's starting his sophomore year of college. And he's like, Dad, this sucks. Wall Street is driving up the prices. And me and my friends have talked about it. And we're never going to be able to buy a house. And it was funny because, coming from a year or two removed from high school, of course, he's not thinking about that at all. But he's on a college campus. Western's a little bit more liberal, so I'm sure people are up in arms about this. And the poor kid, he walked right into this one. He didn't know that his dad had obviously recorded a podcast episode on this and done a ton of research. But I kind of walked him through it. I was like, dude, I get it. I get how you're riled up, and I get, how kind of in general this might think this way. But here's the real stats. And I gave it to him, and he was kind of like, I didn't know that. And I guess it makes sense. So again, don't be like either A, our president and get riled up, or B, my son who gets riled up from probably, having a conversation over a bonfire with a couple of cold ones and his buddies trying to figure out life, which again, I think that's awesome. But just be informed, be factual, and use that to help guide your investment choices. 2026 is not going to be an easy year. We're going to continue to move on. And it's going to be in our terms higher and harder for longer from a rate perspective and from just overall challenge. But arm yourself with the facts, arm yourself with the data, and use that to help form your strategy. And I think hopefully it'll help you guys win. So again, hopefully you got a bunch out of today's episode. Let me know what you're thinking. If you've got other data or if you've got something that disputes this, please send it to me. Again, we'll have everything in the show notes from Business Insider, the Urban Land Institute, the National Housing Conference, Axios data, the Joint Centers for Housing Studies, the Government Accountability Office, like it goes on and on and on. But if you're seeing stuff, let me know. I'm a data nerd. So as we close out today, I hope you learned a ton. I hope you really were able to reflect on the data rather than just kind of emotion. Again, we talked about as high up as the president and as more grassroots as my son getting riled up. But again, it's all about the facts. It's all about the data. But most importantly, use that to your advantage for 2026. How can you be strategic? How can you use it to your advantage as a boots on the ground investor like we are? If you've got other data or you've got different points where it disputes what I just said, I would love to know about it. Again, I don't have all the answers, but hopefully this is something where we can all kind of come together and use it as the right strategy for 26. So thanks for tuning in, guys. We'll catch you guys on the flip side. And thanks for listening to Raising the Flipping Bar.
Elevation, elevation. Flip that house, man, this money for the making. We gon' get it, hustle harder every day, fam. Sky's the limit, time to make this life amazing.